Is a student loan secured or unsecured? Welcome to the world of student loans, the ever-relevant topic when it comes to financing education, and this article will throw some light on this not so glamorous but necessary part of academic life. Let's talk about student loans. As you probably know, pursuing higher education can be quite costly. Tuition fees, textbooks, accommodation, and let's not forget about those everyday expenses. It's not uncommon for students to need financial assistance to make their dreams of a degree a reality. That's where student loans come in. These loans provide the much-needed funds to cover educational expenses, allowing students to focus on their studies without the burden of immediate financial strain. When it comes to loans like this, there are primarily two categories to consider: secured and unsecured loans. Secured loans require collateral, such as a house or a car, which the borrower offers to the lender as a form of security. On the other hand, unsecured loans do not require collateral, but they often come with higher interest rates since they are considered more risky for lenders. For students, the choice between secured and unsecured loans can have important implications. Secured loans may offer lower interest rates due to the collateral provided, making them an attractive option for those who have assets to use as security. However, not everyone has something valuable they can offer as collateral, which is where unsecured loans become a viable alternative. Although they may have higher interest rates, they offer greater accessibility to students who may not have valuable assets to secure their loans against. So, whether you're considering a secured or unsecured loan, it's important to understand the implications and choose the option that best suits your individual circumstances and financial goals. With that in mind, let's go deeper into this expansive topic of student loans. Definition and features of secured loans. Secured student loans are a type of financial aid where the borrower provides collateral to the lender as a form of security against the loan. This collateral could be assets like a house, a car, or other valuable possessions that the lender can claim if the borrower defaults on repaying the loan. The key features of secured student loans include the collateral requirement and loan limits. Collateral acts as a guarantee for the lender, reducing their risk and often resulting in lower interest rates for the borrower. The loan limit is typically determined based on the value of the collateral provided and the borrower's ability to repay the loan. Advantages of secured loans for students include the potential for lower interest rates, as lenders have a physical asset they can claim if the borrower defaults. This can make the loan more manageable and affordable in the long run. Additionally, secured loans may offer higher borrowing limits, allowing students to cover larger educational expenses. However, secured loans also have disadvantages. The most significant drawback is the risk of losing the collateral if the borrower fails to meet their repayment obligations. It's crucial to consider this risk carefully and assess your ability to meet the loan's terms before committing to a secured loan. Examples of commonly used secured student loans are home equity loans and car title loans. Home equity loans use the borrower's home as collateral, allowing them to borrow against the equity they have built up in their property. Car title loans, on the other hand, use the borrower's vehicle as collateral for the loan. Have it at the back of your mind that secured loans may not be feasible for everyone, especially if you don't have the necessary collateral. It's important to assess your individual financial situation and consider other options before committing to any loan. Always weigh the advantages and disadvantages to make an informed decision that aligns with your needs and financial goals. Understanding unsecured loans. Unsecured student loans are a type of financial aid where the borrower does not need to provide collateral as security against the loan. Unlike secured loans, unsecured loans rely solely on the borrower's creditworthiness and promise to repay the loan. The key feature of unsecured student loans is that they do not require any collateral. This means that borrowers do not need to put up their assets, such as a house or car, as security. Instead, lenders assess the borrower's credit history, income, and ability to repay the loan in determining eligibility and interest rates. Advantages of unsecured loans for students include the lack of collateral requirement, which makes them more accessible to borrowers who do not have valuable assets to put up as security. Unsecured loans also provide a sense of flexibility and convenience since no collateral appraisal or documentation is required. Additionally, interest rates on unsecured loans can vary and may provide favorable rates for borrowers with strong credit histories. However, there are also disadvantages to unsecured loans. Due to the higher risk for lenders, interest rates on unsecured loans may be higher compared to secured loans, making them potentially more expensive for borrowers in the long run. Additionally, eligibility for unsecured loans can be more stringent, and borrowers with less established credit histories or lower incomes may face challenges in getting approved or may be subject to higher interest rates. Common examples of unsecured student loans include federal student loans like Stafford or Perkins loans, which are backed by the government and do not require collateral. Private student loans from banks and other financial institutions can also be unsecured, based on the borrower's credit profile. When considering unsecured student loans, it is important to carefully assess your financial situation and evaluate your ability to repay the loan. Compare interest rates, terms, and conditions from different lenders to find the most favorable options. Always borrow responsibly and be mindful of your financial obligations to ensure a successful repayment journey. Student loan: comparing secured and unsecured student loans. Secured and unsecured student loans have significant differences that borrowers should consider when choosing the right option for their needs. Here is a comparison of the major aspects. Collateral requirement: secured loans require collateral, while unsecured loans do not. Collateral can be an asset like a home, car, or other valuable possessions that the lender can claim if the borrower fails to repay the loan. Interest rates: secured loans often come with lower interest rates due to the reduced risk for lenders. Unsecured loans typically have higher interest rates since lenders rely solely on the borrower's creditworthiness for repayment. Repayment terms: secured loans may offer longer repayment terms, allowing borrowers to spread out their payments over a more extended period. Unsecured loans often have shorter repayment terms, meaning borrowers need to repay the loan within a shorter time frame. Approval of criteria: secured loans prioritize the value and condition of the collateral when determining approval. Unsecured loans heavily consider the borrower's credit history, income, and ability to repay the loan. Impact of credit history: credit history plays a crucial role in both types of loans. For secured loans, while collateral is the primary consideration, a poor credit history may lead to higher interest rates. Unsecured loans heavily rely on credit history, and borrowers with excellent credit are more likely to secure favorable interest rates and terms. Consequences of default: defaulting on a secured loan may result in the lender seizing the collateral provided as security. In contrast, defaulting on an unsecured loan may lead to legal action, damage to credit scores, and potential debt collection efforts, but there is no specific collateral at risk. It is essential to always make timely and complete repayments for both secured and unsecured loans. Defaulting on either type can have serious consequences on your financial well-being, credit history, and even legal implications. Understanding the terms and conditions, as well as evaluating your financial capability, will help you manage your loans responsibly and avoid defaulting. Remember, if you're unsure about which type of loan is best for you, it's wise to consult with a financial advisor or student loan expert who can guide you based on your specific circumstances and goals. Determining the right type of loan for you. When deciding between a secured and unsecured student loan, it is crucial to evaluate your individual circumstances and financial goals. Here are factors to consider. Financial situation: assess your financial position, including your income, expenses, and available assets. If you have valuable collateral that you would be willing to offer as security, and you want a lower interest rate or longer repayment terms, a secured loan may be a suitable option. However, if you don't have collateral or prefer not to risk your assets, an unsecured loan might be more appropriate. Credit history: evaluate your credit history. If you have a good credit score, you may have a wider range of loan options, including more competitive interest rates and terms. On the other hand, if your credit history is limited or less favorable, you may encounter challenges securing a loan or receiving higher interest rates. In such cases, an unsecured loan could be more accessible since they often consider other factors like income and employment stability. Risk tolerance: consider your risk tolerance. Secured loans offer more security for lenders, meaning they typically come with lower interest rates. If you're comfortable providing collateral, you may benefit from the cost savings associated with a secured loan. However, if the risk of potentially losing collateral concerns you, an unsecured loan may be more appropriate. Repayment plan: evaluate your repayment plan preferences. If you prefer longer repayment terms to have smaller monthly payments, secured loans may be more suitable. However, if you want to pay off your loan quickly and save on interest in the long run, unsecured loans with shorter terms may be better. Consultation and research: it is critical to research and compare different loan options from various lenders. Explore the interest rates, repayment terms, and eligibility criteria they offer. Additionally, consider seeking guidance from financial advisors or student loan experts who can provide personalized advice based on your specific situation. They can help you understand the implications of each loan type, navigate the process, and make an informed decision. Selecting the right loan type requires careful consideration of your financial circumstances, preferences, and long-term goals. By evaluating these factors, conducting thorough research, and seeking expert guidance, you can make an informed decision that aligns with your needs and sets you up for a successful repayment journey. Frequently asked questions. Q. How does my credit score affect my chances of getting an unsecured student loan? A. A good credit score increases your chances of approval and may lead to more favorable interest rates and terms. Q. Which loan type is typically easier to qualify for, secured or unsecured? A. Secured loans are generally easier to qualify for since they have collateral as security, reducing risk for lenders. Q. Can I use a cosigner for both secured and unsecured student loans? A. Yes, having a cosigner can increase your chances of approval for both secured and unsecured loans. It may also help secure better terms. Q. Can I switch from a secured to an unsecured student loan or vice versa? A. In most cases, it's not possible to switch loan types once the loan has been established. However, refinancing might be an option to explore. Q. Can I negotiate a lower interest rate or better terms on a student loan? A. While it may not be a common practice, some lenders may be willing to negotiate interest rates and terms based on individual circumstances and strong creditworthiness. Q. Are there any benefits to paying off a student loan early? A. Paying off your student loan early can save you money on interest in the long run and free up funds for other financial goals. Final thoughts. Understanding the differences between secured and unsecured student loans is essential when making borrowing decisions. Secured loans involve offering collateral like property, while unsecured loans don't require collateral but may have higher interest rates. Factors like financial situation, credit history, risk tolerance, and repayment plan preferences should be considered. Research lenders, compare terms, and consult experts to make informed choices. Remember that secured loans offer lower rates but risk losing collateral, while unsecured loans are accessible but may have higher costs. It's crucial to assess your individual needs and capabilities before selecting a loan type. By doing so, you can secure the best loan option for your circumstances, setting you up for successful loan repayment and achieving your educational goals.